Record intercompany loans in QuickBooks Online. Let's say you have a client. His name is John Wick. He's a professional hitman. And he's got two companies. One is called For Hire Inc., and the other one is called On Target Inc. All in all, there are actually three entities to deal with because there are the two companies, and then there's John Wick himself. Now, typically when money moves directly between the owner and the company, we'll call it either shareholder contributions or distributions, depending which way the money goes. Another way is, though, that you could record it as a loan to and from the shareholder. And the only difference really is we're talking about putting it in a different section on the balance sheet, right? Contributions or distributions are equity accounts. The nomenclature itself implies equity. We're contributing money into the business or we're distributing money, taking money out of the business. That's clearly an equity section classification. On the other hand, we can just loan money between the owner and the company, or vice versa. And that's actually a better way to go in general, especially with S-Corps, because with S-Corps and equity accounts, if you have two or more shareholders in an S-Corp, their distributions have to be maintained in exact proportion to their ownership in the company. A lot of people don't know that, but if you have two 50-50 shareholders, they need to have the same amount in distributions on the books at all times. A lot of times we'll remedy that by reclassing the difference with whoever's taken out more, let's say, to a loan, which is a Band-Aid. It's not a real good fix. It's definitely not bulletproof, as I like to call it these days. So the safe thing to do is just keep all that activity out of the equity section, and then you don't have to worry about any of those kinds of any of that kind of compliance, right? So here we really want to talk about the less straightforward situation where money is either directly or effectively loaned between the two companies, right? And what's the difference between directly and effectively? Directly means one company directly makes a loan to the other. You write a check and you put money into the other company's account and it's a loan. Effectively could happen a number of ways, but here we're going to use the example where one company charges something on its credit card, where in the example we're going to use half of the amount is really on behalf of the other company and half of the amount is on behalf of itself. So we're going to go through this and we're going to see what the two different kinds of transactions look like, starting with the easy one, the direct money loan between On Target Inc. and For Hire Inc. Now, another thing I want to mention is that when you're doing this, it's best to have both companies open at the same time. How can you do that in QuickBooks Online? Simple, with two different browser sessions. And I want to caution you, some people, if I didn't say what I'm about to say, would probably be commenting on this post saying, oh, you can do it in an incognito window. Don't do it in an incognito window. It's just a bad way to do it. And the simple reason is if I go into an incognito window, I lose the use of any password managers I might have to get access to the QuickBooks file, let alone any other services I might need to be logged into while I'm doing this kind of stuff. And the other downside is I lose access to any bookmarks I might have. And I've done some videos in the past where I've shown you that it can be handy to create a series of bookmarks that take you to places within QuickBooks Online that you visit frequently. So yes, you could do it with incognito windows. I don't suggest doing it that way. I think it's like clipping off your thumbs and then trying to do work and thinking you're doing it more. Imagine trying to work without either thumb. Anyway, I digress. I know I'm going to make some people mad. Some people are going to say, oh, you're so mean. Anyway, so how to do the loan directly. Let's say For Hire Inc. loans $100,000 to On Target Inc. Okay, so I have On Target Inc.'s books here in this one browser session, and I have For Hire Inc.'s books here in another browser session. Okay, so this one is a very straightforward transaction to record, and we're going to set up the accounts in the process while I create this first transaction. So For Hire Inc. is simply going to record an expense. Okay, I know it's not really an expense, but that's just the type of transaction that refers to what happens when money is going out of a bank account, right? So this is For Hire Inc. writing a check to On Target Inc. And you can set each company up in each other's books as a vendor. That works out fine. Okay. This is coming out of checking account for On Target Inc. And the category now is the key here, and that's going to be due to / from For Hire Inc. Okay. Sorry, due to / from On Target Inc. This is where it can get very confusing, right? Whose books are we in? And who are we writing making the payment to? So this is due to from OnTarget Inc. because we're in For Hire's books writing the payment to OnTarget Inc. In the write-up, I explained that my suggestion is that you set this up as other current assets, and you have another other current assets detail type. And that's how we're going to record this. And the amount is simply $100,000. Now what I suggest you do is immediately, when you record this one, go over to the other company's books and record it on the other side. So here on OnTarget Inc.'s books, we're going to make a deposit because they're receiving the money. Okay, we're going to deposit it to Continental Bank. And I'm using the new deposits dialog here. I guess I was offered to do that. I'm not even familiar with this dialog yet. So I just want to find, oh, that's where I put the stuff. Okay, it's weird when, okay. Anyway, receipt from you could leave blank theoretically, but we could also put that it's from For Hire Inc. We'll add that in. And it's going to assume it's a customer. We can change that to a vendor. Because remember, the money may go the other way at some point. That's one of the other points I made in the write-up. You know, just because right now For Hire Inc. is loaning money to OnTarget Inc., the direction of the money could flip the other way. One day OnTarget could pay back the $100,000 and then loan $200,000 back to For Hire Inc. So don't assume it's always going to be the same. And that's why I do these due to from accounts with sort of very generic language. And I mentioned in the write-up, the reason I suggest keeping them classified as other current assets on both company sets of books is for comparability, because they always have to match on both companies' books. Only this way, one is going to be negative while the other one is going to be positive. So it makes it really clear and easy to see if they're not matched. And if they're not matched, it means you have to do some research and figure out one of the two companies is missing something. Could be more than one something, right? So here we go, due to / from. And now we're in OnTarget Inc.'s book, so this is For Hire Inc. And it didn't give me the dialog to add it. Let's try that again. All right, still didn't do it. It looks like in this new deposit dialog, it doesn't let you create accounts on the fly. Note to self, don't use the new deposit dialog until they fix that. Okay, of course I don't know. Back to classic deposit. Let's do that. So we're back to classic deposits, and now we're going to be able to go due to / from For Hire Inc. So here we get to add it. Again, it's going to be other current asset. I misclicked there. Other current asset. That is good. Save and close, and the amount is $100,000. Okay, and save and close. Then the next thing I do is check the balance sheets of both companies to make sure they agree. I know it seems almost silly, like how would it not agree at this point? But here it is. So here we have due to or from For Hire Inc. We're on OnTarget Inc.'s books, and the amount is negative $100,000. Let's go back to the other company. Save and close. And we'll go to the balance sheet. Okay, and here we have due to or from OnTarget Inc. $100,000. So these always need to compare properly. I'll close that up so I can see. Their positive $100,000 always has to be their negative $100,000. So that's the very straightforward direct loan. I'm just taking money out of one company and loaning it to the other company, right? We record a check or we do it electronically, whatever we do to transfer money between two companies. Now I want to look at the other scenario I mentioned. Let's say that For Hire Inc. uses its corporate Capital One card to pay for ammunition, but that it's really split for both companies. It's just buying ammunition on one card for both companies, right? So here's how that works. We're in For Hire Inc.'s books. We are going to record an expense. Again, an expense doesn't truly have to be an expense in terms of where it goes on the P&L. It's just the nomenclature we use for describing when money is effectively going out of the business. Only here, it's going to be a charge on the Capital One card. All right, who did we pay? Acme Incorporated. Some of you are just going to love all of my references here. I hope you all get me. Okay, now if we're truly buying inventory, we would set up products or services. This isn't a lesson on inventory, so I'm going to keep it simple. But this would go into some kind of an ammunition inventory account. Right, we'll call it inventory asset, but only for half of it. Right, if the charge was actually $50,000, remember half is going into to For Hire Inc.'s own inventory, and then the other half is effectively being loaned to On Target Inc., right? Because that's how we're doing it. We're splitting it up 50-50. So 25,000 of the 50,000 goes into inventory. The other 25,000 goes to due to from On Target Inc. So now we've got our whole $50,000 charge, which will show up on our Capital One, but it's properly split here between inventory and the amount of it that's really being used, that's really going to be used by On Target Inc. Right? So I'll say save and close. And now you can see I have the due to from is 125,000 with the inventory asset now showing as 25,000. Let's go to the other company's books and record the mirror image entry. Now here what we're going to do is we're going to do a journal entry. Because a journal entry for this situation just makes sense, right? So we're going to have 50,000 in the due to from. Let's deal with the easier parts first. There's two line items for $25,000. Actually, no. Sorry, there's just one line item for $25,000, right? Because we're not dealing with the whole 50,000 here. We're just dealing with the portion that was loaned by For Hire Inc. here to On Target Inc., right? So this is going to go into the inventory asset. Again, you would normally break this down into items. I'm not doing that here for the sake of time because it's not an inventory lesson. And of course, the offset goes to the due to or from For Hire Inc. And of course, I put a nice description here that says ammunition paid for by For Hire Inc., right? I'll say save and close. And sure enough, here on the books, due to or from is negative 125,000. Over here, due to or from is positive 125,000. And they both happen to have 25,000 in inventory now. So that, my friends, is how you deal with intercompany loans. The real trick to this, to keeping it bulletproof, is making sure that you do record both sides of the entry immediately. The longer you let that go, the messier it becomes, the harder it becomes to piece it back together and figure out what is missing from which side. And I've gone through this where we've had to take an account like this in one company, dump it into Excel, take the other account, the same account in the other company, dump it into Excel, and start lining things up line by line. My friend Greg Cullip has a process which I still haven't had a chance to take a look at yet, but it sounds like it's brilliant, where he actually does a reconciliation to figure out what's on one side that isn't on the other, and vice versa, when these things are not in balance. But if you do it right from the beginning, the way I showed you how here, by entering every transaction on both sides immediately, you'll save yourself the trouble of ever having to review that tutorial. That, my friends, is recording intercompany loans in QuickBooks Online. As always, if you have any concerns, questions, comments, feedback, if you love the John Wick movies, post a comment below, and I look forward to talking to you about this stuff. I love getting your questions and giving you the answers, and your suggestions are obviously always welcome too.